Hello, friends. Imagine it is 2026. The stock market is reaching record highs. Technology companies continue to grow rapidly. Artificial intelligence developments dominate the headlines. Renewable energy stocks continue to climb. Many investors are optimistic about future gains. The question is whether this growth can continue or if a correction is approaching. Understanding Benner's theory provides a framework for thinking about this. Benner's theory explains that markets are driven by human behavior. Fear, greed, and collective actions create patterns that can lead to sudden declines. Investors do not act purely on financial data. They act on emotions and perceptions. These behaviors can accumulate risk in the market without anyone noticing. Over time, the market becomes more vulnerable. To understand this, imagine a situation where everyone invests because others are investing. Prices rise, optimism grows, and caution diminishes. When everyone follows the same behavior, small disturbances can have large effects. History demonstrates this principle clearly. In 1929, the market grew quickly. Investors were enthusiastic and confident. Banks extended credit easily. People assumed the trend would continue indefinitely. When stock prices began to fall, panic spread rapidly. Investors rushed to sell, and the market declined sharply. Benner's theory explains this as the result of collective human behavior creating risk over time. The 2000 dot-com bubble provides another example. Technology companies had rising stock prices without significant profits. Investors bought based on hype rather than fundamentals. When confidence declined, stock prices fell rapidly. Many lost substantial amounts of money. This illustrates how herd behavior can create imbalances that eventually correct. In 2008, the financial sector faced extreme stress. Housing prices declined after years of growth. Financial institutions had taken on high levels of debt. Investors and institutions reacted to fear, and the market declined quickly. Benner's theory shows how emotions and behavior patterns can amplify financial stress in a system. Turning to 2026, current markets show similar signs. Valuations in technology and other sectors are high. Debt levels in public and private markets are elevated. Optimism among investors remains strong. Benner's theory suggests that these conditions indicate growing risk. Even small events could have significant consequences when combined with collective market behavior. It is important to understand that market cycles are normal. Growth periods are followed by corrections. This is part of how markets operate. Investors who recognize patterns of behavior can plan their strategies accordingly. Preparing for fluctuations allows investors to protect their capital and take advantage of opportunities that arise from adjustments. The key lessons from Benner's theory include paying attention to investor sentiment, diversifying holdings, and remaining patient. Markets may experience declines, and timing these events is not precise. Observing trends in behavior and risk accumulation can guide decisions in uncertain conditions. Consider the example of two investors during past market declines. One reacted to fear and sold assets quickly. The other maintained a diversified portfolio and stayed focused on long-term goals. Over time, the second investor recovered and benefited from the market adjustments. Understanding human behavior and managing risk can make a significant difference in outcomes. Markets are influenced by psychology, and this influence will continue. Learning to recognize the signs of collective behavior allows investors to anticipate challenges. In 2026, while growth continues in certain sectors, careful observation and planning can help investors navigate potential adjustments in the market. Knowledge is the most important tool for investors. Market fluctuations are inevitable, but understanding human behavior provides insight into potential risks. Remaining aware of trends, diversifying investments, and making informed decisions creates opportunities even in times of decline. Benner's theory reminds us that markets are human systems. They are not entirely predictable. Emotional responses can amplify trends and create periods of instability. By considering patterns of behavior and evaluating risk carefully, investors can make informed decisions that balance potential rewards with caution. It is important to recognize that corrections and adjustments are part of market cycles. Preparing for these changes is not about predicting exact outcomes. It is about understanding how collective behavior affects market conditions and making decisions that reflect that understanding. This approach can help investors maintain stability and identify opportunities over time. In conclusion, 2026 presents both opportunities and risks. Markets continue to grow, but indicators show potential areas of concern. Applying the principles of Benner's theory provides a framework for interpreting market behavior. By focusing on psychology, observing trends, and managing risk, investors can approach the market with informed strategies that consider both potential gains and challenges. Markets operate in cycles, and awareness of human behavior is essential. Investors who recognize patterns of optimism and caution can navigate changes more effectively. Using knowledge as a guide ensures that decisions are made strategically rather than emotionally. This approach strengthens resilience in any market condition. Understanding Benner's theory helps clarify why markets rise and fall. Growth periods are followed by adjustments, and investor behavior plays a central role. By observing collective actions, preparing for potential declines, and maintaining a long-term perspective, investors can approach the market with confidence. 2026 may bring new developments, opportunities, and challenges. By learning from past patterns and focusing on psychological principles, investors can make decisions that align with both risk management and growth objectives. Remaining disciplined and informed ensures the ability to navigate complex market conditions successfully. Markets are human systems influenced by emotion, expectation, and behavior. Recognizing these factors allows investors to respond effectively to changes. Historical examples reinforce the importance of planning, patience, and awareness in navigating market fluctuations. Applying these lessons in 2026 provides a foundation for informed investing. In summary, Benner's theory emphasizes the role of human behavior in market cycles. By considering emotions, collective actions, and patterns of risk accumulation, investors can make strategic decisions. 2026 may present challenges, but careful observation and disciplined decision-making provide opportunities for long-term success.